Okay, so imagine you're watching like a highly exclusive VIP concert sell out in, I don't know, about 3 seconds flat.
Right.
But at the exact same time, the broader music industry is complaining that absolutely nobody is buying albums anymore, and revenues are just completely crashing.
Yeah, it makes zero sense on paper.
Exactly, and that bizarre, totally contradictory scenario is exactly what is happening in the Singapore property market right now. So, welcome to the deep dive. Today we're basically stepping into the war room.
I love that.
Yeah, I want you to imagine you are sitting across from us in this like
Yeah.
glass-walled boardroom
Hmm.
because we're stepping into the role of senior market analysts today. And we are here to give you an exclusive high net worth investor briefing on the Singapore property market for the final week of April 2026.
And honestly, it is the perfect time for this briefing because if you are just, glancing at the headlines right now, you are getting incredibly mixed signals.
Oh, totally.
So we've synthesized a massive stack of fresh data for you. We're pulling from the URA's Q1 2026 flash estimates, transaction records from EdgeProp, market commentary from Stacked Homes, and the latest flash reports from 99.co.
So the mission today is to cut through all that noise because you have headlines screaming about this massive market slowdown on one page, and then literally on the next page, you're seeing these explosive blockbuster weekend launch numbers.
Yeah, it's giving people whiplash.
Exactly. So we're going to decode that massive divergence. We want to figure out why transaction volumes are, cooling, while at the exact same time, luxury prices are breaking records. And we'll map out the specific policy signals that dictate exactly where the smart money is moving next.
So to really understand the mechanics of what's happening, we have to look at the biggest market movement of the week. Let's start with those April blockbuster launches because they seemingly defy the entire narrative of a cooling market.
They really do. I mean, I
Ugh.
keep seeing headlines about these massive take-up rates over a single weekend. Like, who is actually moving the needle this significantly right now?
Well, if you look at Tango Garden Residences, the numbers are they're staggering. They released 863 units, and over their launch weekend, they sold 853 of them.
Wait, out of 863, they sold 853.
Yes.
Wow. That is what, a 98.8% take-up rate?
Exactly. And the thing is, they didn't achieve that by slashing prices to the bone just to move inventory. They sold at an average of $2,120 per square foot.
Okay, that's definitely not a fire sale.
No, not at all. That makes it the largest new launch sellout by volume in 2026 so far. But the critical piece of data here is actually the buyer profile. This was not foreign capital rushing in to buy up suburban condos. 90% of those buyers were Singaporeans.
90%. Wow. And from the reports, that enthusiasm is not just isolated to Tango, right? I saw some pretty eye-watering numbers for the East Coast as well.
Oh, yeah. Vela Bay in the emerging Bayshore precinct is the perfect example of this. They cleared 72% of their units on launch day.
Right.
And the pricing there set a completely new benchmark for District 16. We're talking an impressive 2,886 fives per square foot.
Oh, wow.
Yeah. It firmly establishes that East Coast upgrader demand is very much alive. And, it actually connects back to that broader March rebound we saw, where over 1,300 new private homes were sold.
Right. Projects like Pinery Residences and River Modern.
Exactly. Pinery River Modern and Revel Tampines all cleared 90% at launch.
Okay, wait, let me pause you there. Because when I see those kinds of numbers clearing 98% of a massive project in 2 days at over $2,000 a square foot,
Right.
my immediate reaction is just skepticism.
Sure.
Like, are buyers just acting irrationally out of pure FOMO? Or is there, I don't know, a calculated strategy driving these very specific suburban and city fringe buy-ins?
Yeah.
Because from the outside looking in, it just looks like panic buying.
I get that. It looks like panic, but when you dig into the psychology and the actual financials, it's highly localized, fundamentals-driven demand.
Okay.
These aren't speculative buyers hoping to flip a unit in a year. These are local HDB upgraders. They have newly MOP-ed flats, meaning they've hit their minimum occupation period of 5 years, and they are taking advantage of the massive equity they've built up.
Oh, I see.
Yeah, so they're making very calculated moves into private property, specifically targeting projects with strong fundamentals. Things like immediate connectivity, proximity to top schools, and a really clear master plan growth narrative.
Okay, so the local upgrader engine is providing the fuel for these new launches. But if we pull back the lens and look at the whole country, the broader Q1 2026 macro data from the URA flash estimates tells a completely different story.
It really does.
It looks like a completely different universe.
Yeah, the broad market is painting a distinct picture of deceleration. Like, according to the URA flash estimates, private residential property prices rose by a marginal 0.3% quarter on quarter.
0.3%.
Yep. That is the slowest pace of growth we have seen in 6 quarters.
I mean, a 0.3% growth rate is basically flatlining. But the volume drop is what actually made my jaw drop.
Oh, the volume drop is severe.
Right. Overall sales volumes crashed roughly 40% from the previous quarter, down to around 4,041 units. A 40% drop in volume is massive.
It is.
And here's where it gets really interesting for me. Basic economics suggests that if transaction volumes fall off a cliff by 40%, the luxury tier, the absolute most expensive real estate, should logically be the very first to take a hit.
Right, because people tighten their belts.
Exactly. But the data shows the top end is entirely defying gravity. Why is that?
This is where it gets fascinating. While the broad market slowed down and volumes crashed, the ultra-luxury core central region, the CCR, is quietly hitting 2-year highs.
Right, 2-year highs in this climate.
Yes. In Q1 alone, there were 188 transactions of $5 million and above. That is well above the 3-year quarterly average.
And the specific price per square foot records are still being broken. I mean, I was looking at Rivergate in Robertson Quay. They just hit an all-time high of $3,160 per square foot for a 3-bedroom unit.
Yeah, it's incredible.
And CCR condos priced broadly above $3,000 BSF are seeing their highest transaction count since, the fourth quarter of 2023? Why on earth is this happening?
Because we are no longer looking at a single unified property market. We are witnessing the deep entrenchment of a true two-speed market.
Okay, unpack that for me. Two-speed market.
Think of it like 2 completely different agricultural ecosystems. The broad market, so the mass market in city fringes, is like a traditional farm. It relies heavily on the rain.
Okay.
And in this case, the rain is credit, interest rates, and monthly salary affordability. When interest rates are high and the macroeconomic weather is tough, that farm slows down.
Right, because buyers there are incredibly sensitive to borrowing costs. They have to pass the stress test of a standard mortgage.
Exactly. But the ultra-luxury segment, it's operating like a high-tech, climate-controlled, irrigated greenhouse. Oh, I like that analogy.
It doesn't care if it's raining outside. It operates on an entirely different set of rules because it is driven by private, ultra-high net worth wealth. This demographic does not rely on a monthly salary or a standard bank mortgage. They are cash rich.
Right.
So what we're seeing right now is private wealth stepping in to fund real estate where institutional capital might be, recalibrating. For these buyers, an asset in the core central region of Singapore isn't just a roof over their heads. It is a vehicle for wealth preservation.
And if we look at the global picture, that makes a lot of sense. We know private wealth is driving the luxury market, but why is that capital flowing into Singapore right now, specifically?
Well, the sources point heavily to global uncertainty.
Right. You have the U.S.-Iran conflict creating major geopolitical and economic turbulence everywhere else.
Yes. And historically, global volatility acts as a major test of nerve for investors. Capital gets nervous, it gets skittish, but Singapore property uniquely benefits in these exact moments because of its entrenched safe haven status.
Of course. When the world feels unstable, multi-generational wealth looks for a jurisdiction with an ironclad rule of law, political stability, and a highly transparent financial system.
And it isn't just individual family offices either, right? I'm seeing headlines about serious, smart money making massive institutional moves based on that exact premise. Like, who is actually placing these bets?
The institutional confidence is staggering right now. Hong Kong Land just launched an $8.2 billion private real estate fund based right here in Singapore.
Wow. $8.2 billion.
It is an enormous amount of capital, and CapitaLand Investment won a $2.4 billion mandate from Income Insurance. And Altalo just placed a $1 billion bet specifically on Singapore's safe haven real estate.
Yeah, that is not speculative hot money looking for a quick flip.
No, absolutely not. That is deep, calculated institutional conviction with a 10 to 20-year time horizon.
Which brings up a really interesting paradox regarding the government's cooling measures.
Right.
Because you constantly hear real estate developers and agents complaining about the cooling measures. They flag things like the additional buyer's stamp duty, the ABSD, as this massive risk to the market. But the data reveals an unexpected, almost counterintuitive side effect of these strict policies.
It really is the ultimate irony of the Singapore market, because the strict entry rules, like the incredibly high ABSD rates for foreign buyers and multiple property owners, essentially weed out the short-term flippers and the speculative day traders of real estate,
Yes.
which ensures long-term market stability. And market stability is exactly what these multi-billion-dollar funds and high-net-worth investors are actively looking for.
So it essentially acts like a bouncer at an incredibly exclusive club.
Exactly.
The government is keeping the crowd manageable, checking IDs, making sure things don't get out of hand or volatile inside. But the strict entry rules are actually making the real VIPs want to get in even more because they know they're entering a secure environment.
That is precisely how institutional capital views it. They are willingly paying a premium for that bouncer, because they absolutely do not want to park $1 billion in a market that booms 20% one year and crashes 30% the next. They want the fortress.
And the other side effect of that bouncer at the door is that local developers are incredibly cautious about overbuilding.
Yes.
They're terrified of getting stuck with inventory they can't sell within the mandated time frame.
Which leads directly to one of the most critical data points in this entire briefing. Singapore recently recorded its lowest unsold private home stock in 7 quarters. Supply is exceptionally tight.
And when you combine a very tight supply with sustained high-conviction demand from both local upgraders and global wealth looking for a fortress, you instantly understand why prices, even in a slower volume environment, are holding firm or even inching up.
Exactly. The fundamentals are literally holding the floor up.
Okay, let's pivot for a second. We've established that foreign and institutional capital is propping up the CCR and the luxury tier. But let's bring this back to the local engine. Because those multi-billion-dollar institutional funds are certainly not the ones buying up 850 units at Tenga Garden residences over a single weekend.
Right, definitely not.
So if the luxury tier is practically walled off for ultra-wealthy foreigners, where does that leave the average Singaporean trying to upgrade? Let's look at the foundation they are using, the HDB resale market.
Yeah, the HDB resale market is undeniably the primary wealth creation engine for the average Singaporean. And despite a slight seasonal dip in transaction volumes around February, which, happens every year due to the festive holidays, HDB resale prices have remained incredibly resilient.
Honestly, resilient feels like an understatement at this point.
It really does.
They're setting records that would have seemed completely absurd just 3 or 4 years ago.
Right.
We are seeing million-dollar public housing flats pop up in places well outside the traditional prime central areas.
Yeah, the data there is crazy.
A newly MOP-ed 4-room flat in Clementi just hit an all-time high of $1.28 million. A 4-room in Bidadari hit $1.368 million. An executive flat in Ang Mo Kio reached $1.35 million.
And we really need to explain the mechanism of how that wealth effect transforms the private market, because that money doesn't just, sit in a savings account.
Right.
Imagine a couple who bought their Bidadari flat directly from HDB. 5 years later, they sell it for $1.36 million. They clear their initial relatively small loan, and suddenly they have a massive injection of hundreds of thousands of dollars in pure cash and CPF equity.
Wow.
So they can take that equity, drop it as a massive down payment on a $2 million private condo, and their actual monthly mortgage payments might barely change.
It's a financial domino effect.
Yes.
That is exactly how you end up with an executive condo market that is absolutely booming right now. We recently saw a triple record-breaking executive condo sell for $3.06 million.
Which is unheard of.
Right. And going back to an earlier data point, Revel Tampines, a new EC, sold 92% of its 572 units at launch for an average of 1,839 PSF. That upgrader capital is highly motivated, and clearly the math works out perfectly for them.
And it is not just families with children cashing out of HDBs to buy larger private spaces either. The sources highlight that dual-income, no-kids couples, the DINK demographic, are emerging as a highly resilient and powerful buyer segment.
Oh, interesting.
Yeah. They are particularly dominant for private condos priced under a $1.5 million quantum.
Okay, I'm glad you read the word quantum, because we need to define why that matters for our listeners. When we say quantum, we mean the total overall ticket price of the home, rather than just looking at the price per square foot.
Right.
So why is that specific sub-$1.5 million total price tag the sweet spot for the DINK demographic?
Well, because DINK couples have a very unique set of priorities. They have strong combined incomes, but without the massive financial burden of childcare, school fees, and, the need for 3 or 4 bedrooms.
Right, they just don't need the space.
Exactly. They can prioritize location, lifestyle, and high-end amenities over pure square footage. So a smaller, well-located unit that costs $1.5 million total fits their debt-to-income ratio perfectly.
That makes total sense.
Yeah, they are a massive stabilizing force for that specific price quantum because they aren't as vulnerable to interest rate shocks. Their disposable income is generally higher.
They aren't getting squeezed from both ends. But I have to ask the uncomfortable question here.
Okay, go for it.
If the foundation of our entire local private market boom is built on these massive million-dollar HDB cash outs, what happens if the music stops? Like if HDB resale prices finally plateau and that wealth engine stalls out, doesn't the suburban private market take a massive hit? It just seems a bit precarious.
It is the absolute right question to ask, and it is definitely a risk to monitor. However, the data suggests that specific pipeline of capital is safe for the immediate future.
Okay, how so?
We just have to look at the upcoming MOP schedule. An estimated 5,000 to 6,000 recently MOP-ed units are expected to change hands in 2026.
Oh, wow, that's a lot of inventory unlocking.
Yes. This means a fresh wave of homeowners will officially unlock their capital gains this year. So the upgrader capital pipeline is mathematically robust for the near term, and it's creating very distinct targeted opportunities for different buyer profiles.
Okay, so bringing all of these threads together, we've mapped out the sheer force of the April blockbusters. We've decoded the fascinating divergence in the Q1 data, where a 40% volume drop somehow coexists with luxury prices hitting 2-year highs.
Yep.
We've tracked the massive influx of institutional capital seeking a geopolitical safe haven, and we've unpacked the mechanics of the HDB wealth engine funding the local upgrades.
The overarching narrative here is that nuance is everything. You simply cannot look at a single headline, whether it's about a 98% sellout or a 40% volume drop, and actually understand the Singapore property market in 2020.
Exactly. So let's deliver the bottom line for the people in the boardroom with us. If you are a buyer listening to this briefing right now, maybe you are an HDB upgrader looking to make that calculated move, or someone looking for your first private property, here is your key takeaway. The broader market is entering what we call a Goldilocks phase.
Yeah, and what we mean by a Goldilocks phase is that with overall price growth slowing to 0.3% and transaction volumes down 40%, the sheer irrational frenzy of the post-pandemic years has finally cooled off.
Right, it's not running too hot anymore.
Exactly. For the first time in 3 years, you actually have genuine negotiating power and a much more balanced inventory to choose from in the resale market.
Right, so do not let the headline, grabbing $3,160 PSF luxury sales, discourage you from hunting. Those headlines belong to the climate-controlled greenhouse, right?
Exactly.
They are a different speed of the market entirely. Hunt for value in the resale market because the power dynamic is shifted slightly in your favor if you aren't shopping in the ultra-luxury tier.
And if you are an investor, your takeaway is slightly different but equally actionable.
Let's hear it.
Follow the institutional confidence. We know unsold developer stock is at a 7-quarter low, which fundamentally protects your downside risk. The smart money is actively looking for assets with strong, irreplaceable fundamentals.
A great example of that from the sources is the $35 million Chancery Hill cluster houses that just went up for sale.
Oh yeah, that's a perfect example.
For those unfamiliar, a cluster house is a rare hybrid. It offers the massive multi-level space of a landed property, but is built together with shared condo-style amenities like security and pools. It is a play on the extreme physical scarcity of freehold landed properties in Singapore.
Exactly. Scarcity is a fundamental. And another strong fundamental is infrastructure. You want to look for developments near major confirmed infrastructure revamps.
Like the Jurong Lake District.
Yes, the Jurong Lake District is aggressively moving into its next phase, and CapitaLand is currently injecting $160 million into a massive transformative upgrade of Plaza Singapura and the atrium at Orchard.
Oh.
Those are tangible catalysts for future capital appreciation. Assets tied to those kinds of core infrastructural transformations will always attract that safe haven capital, regardless of short-term interest rate fluctuations.
Absolutely. Now, before we conclude this briefing and close the doors to the war room, we want to leave you with one final provocative thought to mull over. something that builds on everything we've discussed today, but looks just a little bit further over the horizon.
Right, because according to demographic data, Singapore will officially reach super-aged demographic status by this year, 2026.
Yeah, which is huge.
We are undergoing a massive, undeniable societal shift in how our population is structured.
So far, as we've discussed, this market has been heavily driven by young, dual-income upgraders chasing the next step on the ladder and global wealth looking for a safe haven. But as that super-aged reality fully sets in over the next decade, how will that fundamentally redefine what a premium property looks like tomorrow?
It's a great question.
Right. I mean, if a massive portion of the population is aging, will a ground floor unit with seamless wheelchair accessibility, 0 steps, and immediate proximity to world-class healthcare suddenly command a much higher premium than, say, a 30th floor penthouse with a city view?
It is a brilliant thought exercise because it fundamentally changes the definition of utility in real estate. The bouncer at the club might remain exactly the same, but the VIPs inside the club are going to start demanding very different amenities as they age.
Yeah.
Accessibility might just become the ultimate luxury feature.
It's a fascinating pivot to watch for, and one that could completely flip traditional property valuations on their head in the future.
Well, thank you for joining us in the War Room for this deep dive. Keep an eye on those underlying fundamentals. Don't let the dual-speed headlines confuse your strategy, and we will catch you next time.